Good morning. First time buyers are skewing younger as inventory improves. This is February of 26. The housing market narrative in 23 and 24 centered around affordability pressure, rate volatility, and stalled transactions. But 2026 is showing different signals right now. And according to a new report from Redfin, the typical age of first time home buyers declined to 35 in 2025, down from 36 in 24 and well below the recent peak of 38 in 2018. And that shift matters. It signals that younger buyers are re entering the housing market despite continued pricing pressure. And as a mortgage broker at Medallion Funds, I see this firsthand. And activity hasn't disappeared, it's evolved. So, why are first time buyers getting younger right now? Well, three structural shifts are driving this change, and let's talk about those. One is that mortgage rates have stabilized. The average 30-year fixed rate has eased 6.6, closer to 5 right now, but it was 6.75 in 24. So it's not a dramatic drop, but psychologically, stability matters. And when volatility decreases, buyers regain confidence. And even small rate improvements significantly affect qualification thresholds for first time buyers who are balancing student loans, auto debt, and rising rent costs. Two, inventory has improved across major markets. And inventory expansion in many metro areas has created more negotiation leverage for buyers. And more listings means there's fewer bidding wars and there's more appraisal flexibility. But we needed to get back to where we had seller concessions being readily available. And with improved closing cost assistance, more deals work. And for younger buyers with tighter liquidity, this shift lowers the barriers and cost of entry for them. So, three is slowing home price growth. And home prices didn't collapse, they normalized. And there was a lot of doom and gloom with that, but it's just part of the deal. But slower appreciation has improved affordability ratios for folks. Also, the price points, which affects your down payments, but also your debt to income positioning. And when prices stabilize, buyers can plan rather than react. So let's look at Redfin versus the National Association of Realtors and why their data look different. And Redfin's findings differ from NAR, National Association of Realtors, which reported a median first-time homebuyer age of 40. And the discrepancy stems from how their methodology, basically. And Redfin uses nationally representative household data from the U.S. Census Bureau, whereas NAR uses actual survey responses from recent buyers. Who's right? We don't know, but somewhere in the middle is the answer. Additional data from the Federal Reserve Bank of New York and the National Mortgage Database aligns more closely with the mid 30s estimate, though. The takeaway: younger buyers are active, and even if they're in different data sets, we can measure them differently. So, ownership rates are climbing, and this generational shift is really truly measurable. Gen Z home ownership is at 27%, whereas it was at 26. And millennial home ownership is at 55%, which it was just under 55 last year. And momentum is building, but it's capital constrained is the point. And everybody's got tight budgets right now. The hidden reality is that alternative funding is increasing. And affordability challenges remain real, but wage growth has not fully kept pace with home price appreciation. And many younger buyers are bridging the gap with, say, 19.6% of millennials receiving cash gifts from family members for down payments. 14.8% of Gen Z received assistance. And 20% sold stock investments. And 13% withdrew early from their retirement accounts. And the point is, home ownership will create financial stability for you. So all are good moves. And this trend highlights something critical. First-time buyers today require structured financing strategy and not just rate shopping. And repeat buyers are also skewing younger nowadays. The median age of repeat buyers has declined to 47 from a historic high of about 52 back in 24. And this suggests pent-up demand from households that paused their moves during the peak rate volatility because they had these nice, pretty rates that there's no point messing with it. When rates stabilize and inventory expands, mobility returns. So, what this means for Houston area buyers and for buyers in Katy, in Fulshire, in West Houston, here's the practical takeaway. Stabilizing rates improve qualification certainty for everyone. There's expanded inventory, and that increases negotiation leverage. And seller concessions are more available than they ever have been. Structured loan options matter more than ever. And the mistake many young buyers make, focusing only on the rate instead of the structure to get their deal done. And approval strength depends on a number of factors. Your down payment strategy, where the money's coming from, your gift documentation compliance, because there's paperwork for that. But we also have to worry about making sure you can afford it, so your debt to income positioning, and making sure your closing costs are structured properly with any seller concessions, and make sure we have reserves left over so you're not stretched too thin. And in medallion funds, our role isn't just to quote your rate, it's to put all of those together. And it's to build that approval strategy that aligns with your capital position and your long-term plan. Bottom line is that structural affordability challenges still exist, and they'll probably never fully go away. But incremental improvements in mortgage rates and inventory are lowering the entry barriers for younger generations of millennials and Gen Zs. The first-time buyer market isn't weak, it's just recalibrating. And if you're considering entering the market in 2026, strategy always beats speculation. And that's what I'm here for. Please visit my website, billrapponline.com. Love to talk to you further, and we'll talk more about your situation. Have a good day.